Good evening. This is Tom Alexander. It is Saturday, October 14th. It is about 8:40 p.m. Eastern Time in beautiful Charleston, South Carolina. This is the weekend update that accompanies the weekend report that is published on the website. I also send out a newsletter to everyone on the list notifying of this report and putting an excerpt in there. If you're not receiving that and you would like to receive it, it is free. Send me an email, tom@alexandertrading.com. I will put you on the list. A lot to say this weekend. We are in an uncertain time in the markets. We have exogenous events. We have war, potential very serious war, in several different fronts around the globe. Trading is a profession or very serious endeavor, depending on where you want to slot it in your life. But it's unlike most professions because you can't expect a paycheck every week. You actually can't expect a paycheck every month, much less every minute or every day. And so many people who are retail traders, the Twitter crowd, the YouTube crowd, think that the market is a money tree. You just come in and you shake every day and money falls from the sky and you have some magic secret and you just print money. It doesn't work that way. As you can see, I'm very old. I've been trading for almost 40 years. So I have traded similar conditions. I've traded through several wars, crashes, monetary uncertainty. And right now we're sort of in a perfect storm of all of those things. We're in an election year. We have a very divisive political process ongoing. We have, again, we have the conflict in the Middle East. We have the conflict in the Ukraine, Russia. We have China. So there are all these things that are uncertainties. And to the greatest degree possible as traders, we want to avoid randomness. And what that means is identifying times to trade where you have a greater than normal reward to risk. And right now, there's a tremendous amount of risk in the market in all time frames up and down. So part of my advice to you is to chill. Relax. If you are an inexperienced trader, this is a time to sit back and maybe learn. If you're an experienced trader, and I don't care how experienced you are, it's probably a good time to reduce your position sizing. And that's true across any time frame, where you are a day trader, a swing trader, position trader, or even an investor, because we don't know what's going on. Now, I use I use a very specific methodology to analyze markets and to trade markets, and I share that with you every week. I don't think there's anything that comes close to the objectivity or the accuracy of this methodology, and it's based on how auction markets develop. But auction markets are markets, and markets are subject to, at times, randomness. And when you're in an environment like this, everything that I say and everything that I have printed and put on the website for you to read as of this moment could be, and I hesitate to use this term, but it's quite apt, blown up in a matter of minutes because of some exogenous event. So just be aware of that. The levels that the market itself identifies through this auction process are incredibly accurate and provide an incredible guide. But again, they're not set in stone. There's no magic to the market. The market is going to go where it's going to go. So just play the long game. If you're not in this for the long haul, if you're desperate to make money, go do something else, because this is not for you. The volatility will create incredible opportunity, but right now things are iffy. You have the NDX that's showing a lot of relative strength. It looks like, on the other hand, the Russell wants to go to zero. So that's incongruent with how the stock market, the U.S. stock market, typically works. When you have a strong bull market, everything is in lockstep to one degree or another to the upside. When you have a washout to the downside, everything is in lockstep to the downside. Well, we don't have that now. Last week, I mean, you have the NDX that is just persistently up, and then you had the Russell that's persistently down. And I understand the different components of the two. The technology is dragging the NDX up, and the banking sector, financial sector is dragging the Russell down. I get that. But trust me, and you can go back and verify this for yourself. In strong bull markets, they're both going to go up, and in waterfall declines, they're both going to go down. And when they're doing different things, that makes me nervous because it's something I use and it's something I read. They will eventually get in sync. And when they get in sync, when all four of the indices get in sync, whether it's up or it's down, that's when you can get the best read on the markets, on the indices, and that's when you can get the best levels. So with all of that said, let's take a look at some charts. And we're going to start with the S&P. Now I'm going to show longer term charts this week because again, we're in an environment of incredible noise. So I want to go out in time frame to look at the bigger picture and get away from the noise as much as possible. And if we look at the SPX, the S&P 500, the upper level is basically last week's high. The lower level is the week before's low. And we'll move over to the NDX. And the NDX, as you can see, is showing relative strength. But again, it's basically last week's high and low, and then the low, sort of a double bottom between the week before last and the week before that one. And then let's look at, I want to end with the Russell. And the Dow is the index that's the most simple of all. It's the least it's meaningful in my mind because it's only 30 stocks. But the reality is in the Dow, the level is last week's high and the week before's low. Now, if we look at the Russell, this is the one that has basically lagged all year. But all year, it's also formed, if you look at this is balance. This is a consolidation. We're sort of testing the upper cusp of the low extreme of that balance now. Last week's high is going to be important. Now let's go to this view and let's look at the profile view. Let's look at the market profile graph. And the market profile graph is a graphic format. I'm not going to go into a big lecture on market profile tonight, but it can at times give a very, very accurate view into the auction process. And I think where we are in the auction process right now is that we're in the fourth quarter auction when you're looking at this particular time frame, and we're establishing that auction range, meaning the market is trending here. Basically, the market is generally trending lower in a new distribution. This is the Russell, obviously, the profile view of the Russell, and you can see down here, this is the low extreme. This is a rather broad range of an area that really needs to hold, in my view, under a bullish scenario. If we close below 1641, I think that's the low print from back here. It's I have that on the bar charts. That could be immediately and extremely very bearish. Now, it could be. It has to be assessed in real time, along with what the other indices are doing and what market internals are doing. Okay, let's take a look at the SPX. Now, the SPX, the profile perspective, I think, is a little clearer because to me, this completed an auction. Now, this was the third quarter auction, but I think it completed a week early. And so it's possible that this is the upper extreme of the range and last week's low is the low extreme of the fourth quarter auction range. But that would be a pretty narrow fourth quarter auction. So I'm thinking that the upper extreme is more likely to be 44.38, 44.72, and potentially, especially if we take out last week's low, then we might see 41.48, 41.09. And the NDX. And the NDX, we're almost certainly going to get range expansion out of what is the auction range for the fourth quarter. You can see the third quarter auction itself was an extremely narrow range auction for the NDX. And the reality is, it's possible that we're still in this auction. We'll find out. But the upper extreme and the lower extreme, I have a lot of confidence in these levels being at this point, being the inflection points immediately as we head into next week. Last but not least, let's take a look at the internals. Now, the internals that I use are derived from NYSE data. I use NYSE advancing minus declining issues breadth. And then I just take a 10-day moving average, which is the red of NYSE advancing issues. A 5-day moving average of NYSE advancing issues is the green. And that can give us, at times, a tell. It can give us extremes, upper extremes and lower extremes. And in particular, in washouts, downtrends, bear markets, this work is more accurate than when you're trying to use it to pick the top. But where are we now? I'm not real sure. I posted last week, the blue lines you see on the chart are times that the 10-day moving average reached to or below the level we're at now. And in almost every single instance going back since the high back in 2022, we've bottomed and had furious barn-burning rallies. Now, I also showed in last week's update the instance of 2020 when we went a whole lot lower following this level being reached. So at the moment, it's not really giving a lot of information. It's something we're just going to have to wait and see, and this will clear up. Okay, guys, if you found value in this, I would very much appreciate it if you would subscribe to the channel and you would like the channel. It helps grow the channel. Enjoy the rest of your weekend. I will be in touch.